Hey everybody, welcome to Cover Call ETF Investing, your central hub. As always, deep Cover Call ETF data. And in this video, it's all about you guys. Just taking your live questions. This is the first ever live stream I've ever done here on YouTube. So hopefully you all can hear me. Just message in the chat if you can't, or if you can't see me for whatever reason. If there's any technical issues, please, that's probably the best way for me to know if something is just wrong or something's going on. So typically I've done a bunch of one-on-ones. Of course, I have the Patreon where I have like small group meetups, and I thought it'd be a good idea just to do maybe something like this, once in a blue moon, maybe once a quarter or something, just to answer any questions that you all might have regarding Cover Call ETFs. So by all means, head into the chat and ask away. Oh, hey, Opa. That's my father-in-law joining me on this first chat. Thank you so much for tuning in. I think my brother-in-law might be in the chat as well at some point in time. So yeah, if some of you don't maybe have any questions, then I'll kind of freewheel along. There's my brother-in-law. Hey, Jonas. So obviously with this being the first, and if for those who are out there who are maybe not sure what to ask, I can go through maybe a little bit of a history of why Cover Call ETFs might be for you. We'll talk about this between, I don't know, for the next 60 to 90 minutes. We'll just see how the conversation gets to at around 7 o'clock my time here on the West Coast. But for those of you who watch my content, you know that I've now had this channel around for a good, probably almost coming up on a year and a half. I created it really because, I found this really amazing strategy called Cover Call ETFs. Not maybe at the time when I discovered it, I think the mainstreamness of it was just starting to pick up. And I found that this strategy, I think, is of course great for retirees, people who are about to retire. I know my father-in-law is invested in income investing. So is my own mom. Helped them out with developing variations of a portfolio for them to support them in their retirement. And that really is the power of this strategy. I mean, getting more of your return up front here in the now versus putting all your money into an index fund, say an S&P 500 index fund, and then just letting it ride out for 20, 30, 40 years. But when I first started investing, I was okay with that idea because I didn't know any differently. But as time went on, I kind of heard about this stuff called Cover Call ETFs, kind of did my own research about them, and just the fact that they paid out these high yields. I really wanted to, as I got more into it, I really wanted to just see how it could be done by getting a 10+%. This was before I had the channel, but the idea of getting a 10% yield and getting a 10% yield, but also getting some price appreciation, I was very fixated on that. I really wanted the portfolio to be able to grow naturally, ideally beat out inflation if possible. Get some growth out of that if possible. And I think with a lot of my portfolio posts that I show and reveal every Saturday on the community tab, I know it's not 5 years of history, but at least it's something. And I mean, this year has been quite the surprise. I have found the portfolio on a total return level is beating out all the other indexes: S&P 500, NASDAQ 100, the Dow Jones Industrial, and the Canadian TSX 60. When it was earlier in the year, I thought that'll subside, but now I'm in contention to finish out the year with 4 months to go. So now I'm revved up to, I don't know, beat the 2024, all the indexes. Yeah, so I mean that just goes to show that the combination of price performance, but also dividends, reinvesting, uh, showing just hey, I think there's something to the strategy to be said, and I think fine tuning the portfolio in such a way that to get your 10% yield, I think it obviously brings your financial goals just a little bit closer. You don't need as much money to hit those goals. Oh, hi Kelly, a regular. Good to have you in the chat. Yeah. Shoot, what was I saying? Um, yeah, just talking about performance. Again, the main purpose of the funds I talk about and my own strategy is to really hone in on that 10 to 12% margin. And then from that point, with the way my TFSA has gone, I've basically ditched all the sector funds here in Canada. Once I have uh, a taxable account, that's when I'll probably start picking up more of the sector specific stuff. But now the TFSA is all in ones, right? The familiar juggernauts, HDIV, HDIF, EQCL, HYLD, BMAX. I think I got HTAE in there. So there's about 6 funds in there. One sector fund to give it a little bit of extra rocket fuel. Hey, Liam, how's it going? Congrats on your first live stream. Looking forward to this. Thanks for all you do here. Yeah, thank you, Aleem. Really appreciate that. Yeah, it's honestly, never did I expect that I'd be doing a live stream on YouTube, but here we are. So happy to do it. And Kelly says 10 to 12% is in my mind on the safe side of investing these days. Can't go wrong. Yeah, no, for sure. Kelly, like I said, you bring up a really good point. There are very high yielding funds out there that I know those of you who follow the income investing channels that can yield up to 20, 30, 40%. Those funds, you got to be a little bit more hands-on. And I just think you just got to be careful, because it depends how hands-on you want to be. I want to be actually hands off. I don't want to. I just want the portfolio to grow over time, ideally, and collect my 10 to 12% yield, if possible. Collect that 10 to 12% yield. Opa writes, what is a sector fund? So a sector fund would be basically like one specific industry. So energy would be a sector fund, and that invests in only energy stocks, or a bank fund or a financials fund that only invests in banks, or there's utilities. That would be another good one out there. So yeah, those would be considered sector funds, where index funds can be that, but in this case, a lot of the index funds we refer to is broad market base. It's basically all the sectors. And typically that's a lot of the all-in-ones, ETFs that invest in other ETFs, which a good example would be maybe HDIV. It's an all-in-one ETF. So that ETF invests in a bunch of sector-specific ETFs, right? So that would be, gold, energy, financials. What are the other ones in there? Maybe QMAX, I think, as well, a smaller position in there. RPS 99, been really happy with EQCL, but disappointed its AUM is not picking up. Hoping with a distribution increase, it'll get more attention. For sure. I've been on the EQCL train ever since its inception. I really wanted some globally diversified fund. What I didn't like about EQCL at its inception were those 2 funds, the emerging markets and developed markets ETFs that were inside it. They weren't even cover call based. So you had 40% of the portfolio that wasn't cover call based. Now, it still was able to pick up an 11% yield at the time. Still impressive, but I wanted a full slate of cover call ETFs, and we now have it. So I picked it up with that in mind, and then also with the additional hope that they would raise their distribution now that they have these. Basically, now that they have all cover call ETF coverage, but they haven't raised the dividend yet. So I've been kind of holding out that they will eventually do that. I wonder if there's something behind the scenes that Global X is just being cautious with. Not too sure, but yeah, still holding out hope that they will do that. In regards. RPS 99, their AUM has been growing, even though it's at roughly, I think, just off the top of my head, it's about $15 million. Now, compared to a lot of the other all-in-one funds, that's obviously very small. EQCL hasn't been around for even a year yet, but its AUM has been skyrocketing. You know what? Let me just check that out. I do have the tracker out. So I'm going to head down to Global X and just see exactly what their month-over-month coverage is, just so that I can give you guys just a more accurate number on EQCL as far as growth is concerned. It started January at $5.6 million. Between January and February, it saw a 40% gain. February, 7.8 million. It saw a 9% gain into March to 8.6 million, saw a 27% gain between 8 to almost $11 million. It had this kind of weird drop off between April and May, from 10.9 million down to 9.6 million, so 11.71% drop. Between May and June, jumped up to $11.34 million, so that's a 17% gain right there. And then from June to July, it once again jumped up 18% from 11.3 to 13.4. And then with the latest tracker, it jumped from 13.5 all the way up to 15.8. Good for a 18.4% increase between July and August. So it's grown like 300 well, whatever that is, year to date, 300%, not quite, but somewhere in there, 275. Don't have the year to date change from the start of the year, but either way, that is considerable growth right there. And don't forget that the underlying ETFs inside of EQCL are their AUMs are quite healthy. So that's maybe just one thing to keep in mind. Okay, so let's move along to maybe let's see. Oh yeah, sorry guys about the ads. That's here. If it comes up again, I'll try and just skip them. They're YouTube, they want to bombard us with ads, so they're given less control over for how the creators want the. I don't want ads for a live stream. That can be for like a regular video. Opa asks, what gives you rocket fuel? Well, typically rocket fuel would be, something that will give you extra lift in the portfolio, more price appreciation. So what sectors will typically do that? Will energy do that? No, because energy is pretty what we call cyclical. It goes up and it goes down. Oil's been trading at the same, if you average it out over about 20 years, oil's been trading pretty much at the same price, right? So you see periods where it jumps up, falls, up, down. So that's not what I would consider rocket fuel, but like what I would say is rocket fuel would be tech sector. So tech sector has what I like to call it's the rocket fuel in the good times. It's an anchor in the bad times. But over the course of the long term, it'll overall be the rocket fuel in your portfolio. So that's why I have a fund that's pure tech, and it has about a 20% weighting, that being HTAE. It's got a pretty good yield these days. It was maybe 2 months ago, it had an 8.6% yield. Now it's above 11%, maybe 11.5%. Yeah, so HTAE is definitely a solid pickup right now for Canadian investors who want exposure to the American tech sector. And I believe its price performance is the best out of all the the tech funds here in Canada. On a total return basis, I don't think that's the case, but at least its price performance is pretty good that way. Let's see, what else do we got here? Aleem asks, I own RMAX, a sector fund from Hamilton specific to REITs. If you were going to pick 2 sector funds, which sector funds would you go with? Utility energies, and why? Yeah, I think I've made videos about this, that with a taxable account here in Canada, obviously if we pick up more Canadian-based stuff, the higher your chances of it being a much more tax efficient portfolio, if that is your aim. So in this case, as far as sector funds are concerned, I mean, I think my big ones are ENCL, right, Global X, Canadian Oil with 25% leverage on it. I really like that fund. It had done really well for me. I don't own it at the moment. I'll pick it up again. It was sad to get rid of ENCL. It is by far, hands down, the king of energy cover call ETFs in Canada, in my opinion. And then, so yeah, I'd take energy. I mean, we live in Canada. Canada is a very cyclical place, so you want to take advantage of the sectors that have that best return with that. Well, with the cycle that you can get from it. So oil naturally is a big one there. And if I had to pick another one between financials and utilities, I really want to pick utilities. Just because we need utilities to, even though they're super boring. Yeah, I'm just going to go with UMAX. I really like UMAX. You get a 14% yield, no leverage on it. And that's another fund by Hamilton. The utilities sector for cover calls here in Canada, I mean, I believe BMO has one, but it's under 10%, might be in the 6% range. Harvest has one. I believe it's Hubble, or no, that's wrong. That's Huddle, HUTL. And then they have a leverage version, which is HUTE, HUTE. HUTE is just maybe over 10%, 10.5%. And it's more globally diversified, whereas UMAX is specifically Canadian utilities. But what I like about it is you get the industries of railways, telecoms, pipelines, and then you have your natural utility companies like Emera and Fortis, for sure, is in there. So maybe you get about, I want to say, maybe 20 holdings in there as well. So yeah, I really like UMAX. As far as the financials one, I'm just going to throw in a third as well. But probably at this point, yeah, I mean, I owned HMAX, BKCL. I like them, but I think next go around I might go with Bank, just because I haven't owned Evolve. I don't own any Evolve ETFs, so I don't mind going with Bank. But you know what? That again, I could end up by next year. That's when I plan to have have my TFSA maxed out by next year. So I'll most likely pick up Bank then. Oh, another ad coming up. Let's skip that. Okay. So yeah, probably those two anyway. Let's see. Kelly writes, thanks to you, I pay more attention to AUM. Now it's like a health checker. Yeah, for sure. Of course, Kelly, especially through the tracker, AUM is a big deal. It really, I think that's AUM is going to be a weather bell for the health of the fund. And now that I'm tracking the history of it, it's much easier to, basically kind of give the community a heads up on certain funds that I think are, could be in trouble. And you need to look no further than the 2 most recent delisted funds, which are actually by Harvest. And look, there's probably right now, I think on my tracker in Canada, there's probably 150 funds. Not all of them are going to make it. So over a period of time. So I think it was HBFE and HLFE. Both were leverage funds. I think one was sort of a brand leaders, and one was like a Canadian a diversified Canadian income fund, something like that, off the top of my head. But you know what? Their AUMs were just small. They weren't like they were declining. Their liquidity was actually declining, actually quite remarkably. HLFE, I want to say from the periods of January to June, it dropped like 90+%. Right. So it just liquidity dried up like crazy. And for those who maybe don't know, like liquidity, why is liquidity important? When you go and buy a stock or you go to sell, usually depending on its liquidity, it might be a pending buy or it could be a pending sell. So it might take some time for you to actually own that stock. But if it's really low, there's a chance that you could end up paying more for it. And that just has to do with the bid-ask spread that you see on your daily quotes inside your brokerage. Most of these funds overall are pretty close. So even the funds that, deviate and are under, maybe 1,000 units a day, they're typically pretty close, but I still wouldn't take that chance. And I think there was maybe a fund by Evolve. I gave the Patreon community a bit of a heads up on, which was LEAD. It was another one of these, brand leader style cover call ETFs, and just watching AUM, watching the what do you call it, volume, watching it trend lower month over month. I basically just said, hey guys, like there's this fund, I don't know, because I don't talk to any of these people, any of the fund managers, but there's a shot that, like this could be a fund just to be just cautious of. So that was kind of that's actually my only warning that I've given out so far. So just something to watch. Let's see. Let's move down the list here. Reagan Brown. Glad you can join us, Reagan. What do you think about SMAX, considering it doesn't use leverage? It's doing very well. I don't hear too many people talking about this one. Yeah, good point. SMAX is a really massive chunk of HYLD. Off the top of my head, it's like 60 or 65%. So HYLD is by far it's meant to track the S&P 500. More specifically, it's meant to track VSP, which is the non-cover call version of HYLD. It's a Vanguard index fund, so it just tracks the S&P 500. So HYLD is trying to match that because is it hedged? I think it's hedged. That's why. It's a hedged ETF. Okay, so currency is taken out of the equation in that regard. And so HYLD is by far SMAX, like mostly SMAX, and then another big chunk is QMAX. So you basically got the S&P 500 and the NASDAQ 100 within HYLD. So why don't people talk about it? I mean, I think it just has to do with you get more people talking about HYLD, but I think HYLD is, with its performance this year especially, I think reflects well on the performance of SMAX and how SMAX has helped to really elevate HYLD from a fund that was very strictly, in my opinion, income based last year to now a growth style cover call ETF. I think it's probably the best price. It has the best, I think, chance for price performance in the long run, HYLD. And right now that's definitely a large chunk of my portfolio between HYLD and HYLD.U. Let's see. Okay, Kelly. Aline, BTCY. Yeah. BTCY. I'm not a big Bitcoin guy, but you know what? I appreciate what Bitcoin's trying to do, the problems it's trying to solve. I actually like Bitcoin from that point of view. There's a book called Thank God for Bitcoin, which is a great, I think, introductory to Bitcoin. Basically, 75% of this book is about the history of money, which I didn't know about until I made it my way through it. Another 25% of it is actually about, the use cases for Bitcoin. But learning about the history of money and how inflation works, and how, throughout history, fiat currencies have come and gone, which we're all subject to, right? Whether you're in Canada or you're in America or wherever else you are in the world, you're pretty much subject to a fiat currency, money by decree. So check that out. It talks about how Bitcoin can be a more moral money. And basically, if there was scarcity, right, government entities, departments would have to actually fight for, limited resources, right? Bitcoin has a limited number. So I think from that point of view, I think it would trim a lot of fat for sure. So yeah, definitely check that book out. It's a really interesting read, and it's a short read too. It's a good introductory to Bitcoin. Okay, let's move along. KD, glad you can join. KD, hey Jordan, real phenomenal videos, always a great listen. To add rocket fuel to my TFSA, I increased PCT. I increased PCT of tech funds to 25% from 20. These types, sorry, I'm botching your question. I'm sorry. Types of limited, no greater than 25% in the portfolio. Yeah, for sure. I mean, I got one pure tech fund that's at about 20%. But again, I just use that to help boost that price performance that I want to get out of it, while still trying to maintain that yield as well. Jumbo, I believe your real name is Damien. So yeah, you're a longtime follower. Thanks for coming into the chat. Jumbo, I don't like investing in funds that have less than 50 million, or ones that are just just are not growing after a few months. Yeah, I mean, that's fair. I think, I think if a fund is probably under about $10 million, I think there's probably something to be said about, if it stays in that range for a long time. I don't think that the fund managers are really going to be too interested in pouring more, resources into the fund to, when there's, maybe they have other ideas, they're able to, they have other cover call ETFs coming online that will could potentially do better. I don't think a fund manager needs to bloat their lineup. If it just means that, there's a bunch of funds that are just kind of there just for quantity, just focus on quality. Like, that's honestly, I don't know. It's to me, it's very simple. I don't need, 10 new funds coming online every single month, because I know in the end, most of them are, in the long run, are probably going to fail anyway at some point in time. And sticking with the winners, those will always come. They will always be a cut above. They'll always come to the top of the heap. Not a problem. So I think, yeah, EQCL for me is the only one for me under 50 million. I think HTAE recently passed 50 million. That's the only one, but I'm as far as AUM is concerned, I'm taking a chance on that one. I actually do think it has some really strong growth potential. As soon as I saw it, when it first came out last October, I thought this will be, I think, this will be eventually, I think, be a flagship fund for Global X eventually. But it obviously needed to sort out some of its cover call, or half the fund being cover call based, the other half not being. So I think in time, EQCL definitely will grow into a powerhouse. In my opinion, it's doing just that, right? When your AUM is increasing 17-20% month over month, that's powerful growth. So EQCL still, in my opinion, has lots of runway to grow. Okay. Let's move along. Hey, Jordan, this is from Rodrigo. Hey, Rodrigo, I see you're a recent Patreon member. Thanks for supporting my work by picking up the tracker. Hopefully it's working out for you. So far, I haven't had anybody say nothing bad about the tracker, which is a really strong positive. Hey, Jordan, I'm a new subscriber and a relatively new to cover call ETFs. Big thanks to your videos and the tracker. Yeah, no, yeah, glad, like I said, glad you like it. And if you call this if this is something you're going to call your mainstay strategy for the long haul, no joke, no BS. I do think that the tracker will save you hundreds of thousands of dollars in the long run, just so that you stay on top of things. But that's the key. You got to stay on top of it. If you just, copy my portfolio or copy somebody else's without really pouring your own dreams, aspirations into it, I think you're bound to just get disappointed eventually. And the tracker is a good way of really kind of helping formulate those future plans. And then what else here? Can I get your opinion on the US yield max cover call ETFs? I see they tend to have a bit of a NAV decay, but if I reinvest, it seems like it can still be a great amount of yield left. Yeah, so for those who aren't familiar, yield max, they produce these really exorbitant yields, 40%, 50%. I think Coiny has the highest one at like 120%. Yeah, it's huge. I think I did a video on this, and I know many of you are out there are fans of yield max. Me personally, I'm not. I just don't think that I mean, you know what? Hey, in the long run, if they turn out to be great funds, all the power to yield max and Defiance and and Curve and all those other cover call funds out there like yield max. But I don't like these super high yielding funds. I find them trendy, and you know what? It's when they first started coming out, I just kind of got a bit of a sketchy feeling about them. And but again, I think in the video that I made about Defiance and yield max, the reasons why I don't invest in them was their strategies don't actually own the underlying investment. Which, I mean, I'm kind of before the channel, I was reading a lot of like Warren Buffett stuff. So very much so that many of like Warren Buffett's like principles, actually, I still kind of keep. So the idea of treating your investments like a farm, right? For them to be able to produce something tangible. And I like the idea of having something tangible. So investing in things with an actual underlying investment to back it is something I just want to keep with. And that actually helped me narrow down what I actually wanted. So, I mean, there's a sea of cover call ETFs, this big, but, once you put some guardrails in place, I think it's much easier to define what you don't like versus what you do like. And yeah, for me, once I kind of identified that, these funds aren't for me, but if they are for you, hey, great. I just think that they are. I think you just got to. For me personally, I would have to give it more time. But I'm tracking them. I watch them, especially in the tracker. I have the Canadian tab. I have the US listed tab. So I follow all their AUMs, and I still keep good track of them. But I think overall, even though people see these high yielders, that's left the 10%, 11%, 12% yielders kind of in the dust. I certainly have seen my fair share of comments of, I don't want to invest in anything, that's 14%. And it's like, I mean, there are some, I can't believe there's stuff at 10% that is still able to perform really well just on a price performance level. All right. I gotta catch up to all you guys here. Let's see. Oprah writes, what is your prognosis for the economy and the investing in general over the next 6 months, given the U.S. general election? Who wins, potential war, etc. I mean, sorry, the more or less kind of general answer for any sort of bad news is keep investing. There have been, in every generation, there have been some obviously monumental events that have happened. And, a good example I like to bring up, because this is Ben Graham, who is the mentor to Warren Buffett, and that was his book was the first one I ever read, The Intelligent Investor. It was like a textbook, 600-page textbook. And I thought about it. I didn't read about this, but I thought about this dude who wrote one of the most influential investing books. He was born in I want to say 89 or 1890. But think about what this guy had to live through and write the best, or one of the most influential books in 1949. He had to make it through the Spanish flu. He had to make it through World War I. He had to make it through the Great Depression. He had to make it through World War II. And a few years after World War II, he writes The Intelligent Investor, and that's still a bestseller to this day. And I got to say, if I'm putting myself in his shoes, I can't imagine what the world was like in those decades. And you're just looking for good news anywhere, but flu, and then depression, and then war, and then more war, and then that would be exhaustive. So I think a lot of the stuff you see online is just fear mongering. It's right. I mean, it's especially on YouTube. It's you get these sort of danger, act now, thumbnails, or like the very first pictures you see, they're called thumbnails. Urgent, act now, panic sell, buy the dip. If you don't, you're stupid. I just think, if you're really feeling, I don't know, if you feel like you need to sell like right this minute, or, take a good 24 hours just to I'm having these strong thoughts, but, I got to just back off for at least a minimum of 24 hours, I think is a pretty good rule of thumb there. But I remember when, what was it now? People just shrug off war. They just do. I mean, Ukraine, Russia, they kind of it took a hit on the first day when Russia attacked Ukraine. I remember that day. Oil spiked that day, and the market went down 3%, and then it just recovered. Just people have short attention. I just mean in general, like the society has a very short attention span, so we kind of just sort of move on despite inflation fears and geopolitical issues and money printing issues. Anyway, let's move on. Like I said, I'll try to be a little bit faster. Reagan asks, with all the overlap with similar cover call funds, have you worked on a best of the best list based on MER, total return, tax efficiency? There are so many to go through. I know, Reagan, there are, but hey, the tracker makes it all way easier because you're able to filter everything. Again, the tool I've created, you can filter pretty much by MER. You can filter by any kind of management fee. You can filter by total return, and I have a tax tab that you can you can check out where it breaks it down by the numbers, and it also breaks it down by percentages. That's actually something I was playing around with recently. I was looking at just what I looked at. I was contemplating if I had my TFSA portfolio in a non-registered account, I'm like, whoa, what would the tax factors look like? And I think the average ROC, like return of capital, which is tax-free, most of those funds have over 80% or at least 80% ROC, which makes even having those funds in a non-registered account pretty tax efficient. So that was something I was playing around with recently, but obviously that tool definitely helps me out in that regard. Aleem, Rodrigo and I worked together, spent a few hours with him in meetings today already, and now it extends into the after hours. Yeah, no, that's great. I got my brother-in-law and my and my father-in-law on the live stream right now. So yeah, no, it's great when I think, Aleem, you were telling me that you guys at your work were checking out the tracker together and kind of just strategizing as a group on work hours. But no, that's all good. Trust me, it doesn't matter what industry you are. We all have those side conversations about investing. And I'm certainly guilty of that as well. Scott asks, hey, Jordan, thanks again for doing this and all you do. Sorry, I am late. Oh, Scott, yes, you're Maple Ridge. Yeah, a local to the Lower Mainland here in Vancouver. So yeah, thanks for joining again, and again being a Patreon subscriber and supporting the work there. Uh, yeah. Let's see. Kind of moving down the list here. Kelly, what are you writing? Artigo, I have a little dollar bills in 3 yield max funds to boost my riff until the new year. Again, like just because I don't invest in yield max doesn't mean you guys can't. Obviously, it's just I'm much more cautious. In fact, I'm so cautious. Like the only I have my wife had I've set up a spousal RSP for her, like a retirement account for her. I think many of you have heard that. So all my currency is in US dollars. I'm not just investing in yield max. I'm not even investing in pretty much any American cover call ETFs. I'm very picky with the American side of things. I find the Canadian and American side of things it's a different environment, and each offers, I think, unique strengths. I think the Americans do a way better job with their fees. We definitely pay for way more higher fees here in Canada. I do think the Canadian side of things is a little bit more. It might be surprising to say, U.S. is obviously much more known for innovation. But on the Canadian side of things, I actually find that in the finance sphere, the Canadian finances tend to be a little bit farther ahead at least with the cover call stuff I'm finding, right? A good point would be stable distributions, stable monthly distributions. And there's only only maybe 2 or 3 funds on the American side that do it. I think like the Simplify funds do it, Maxi and SFAL, they do it. They have stable distributions. That one by Neos, Spy Eye is really like that is probably the closest I'd come. I was pretty tempted on picking up Spy Eye, and that AUM has just been growing like crazy. Yeah. So, Spy Eye would be a great pickup, I think, in my opinion. And its distribution it's not totally stable, but it does fluctuate just a little bit. A couple cents here, a couple cents there, in either direction. So that's pretty stable. And I know there's others that are still that are pretty close. I think like FEPI for a while. It's a pure tech fund, had been fairly stable, but its distribution has started to decline for whatever reason. Jordan, what do you recommend for funds in a TFSA that are down like 15 to 25%? Given okay dividend, I try to wait it out like RS or trim the fat, cut the loss, and put funds in a flagship. I'm not going to hold back on this one, but mainly because I'm just speaking out of experience. I started investing in cover call ETFs with ZWC. It's a BMO Canadian high yielding cover call ETF. It had this was early 2022, and it had maybe a 7% yield. I held it until October of 2022, and because we saw that bear market in 2022, I can't remember exactly the portfolio size at the time, but it went down. I was down like $7,000 on it. In comparison to the portfolio size, and I just trimmed it. I remember seeing HYLD in a YouTube short, and I'm like, what's this? Like 13% HYLD. No. Did an ad come on again? Oh no, I think I missed it. I see it, and there's like an ad alert. Like I've been exiting out of the ads just so that you guys don't have to experience get a Mazda commercial or something. So hopefully the ad's over. You guys can still hear me. But anyway, what was I going to say about that? I just decided just to cut it off altogether. You're losing time, and that's your biggest commodity with investing is you can gain, you can lose as much money as humanly possible. It's truly you got to almost think of it like if it's infinite in either direction. But time is a commodity. So, I'd say just cut it, especially if you're not happy with it. If you're losing sleep over it, you're, tossing and turning about it. If it's eating up a lot of, your mental energy, if you don't believe in it anymore, I think that's the big one. And you feel like, especially with cover call ETFs, you've kind of grown past maybe a certain fund, then yeah, just move on. I remember talking to, I think many of you are familiar with Brandon Beavis, and I've gotten to meet him a couple of times, and we were actually, we were talking actually about Adriano's portfolio, and people give Adriano flack for, what Adriano would say, streamlining the portfolio. But what I told Brandon, which he told me, he's like, oh, I never thought of it that way. I'm like, look, if Adriano stuck with his original funds, how popular do you think his channel would be? Probably not as popular as it is to this day. I think many of us have learned off of Adriano, and he's kind of moved on with the times. And it's actually encouraging to see someone that is recognizing that this industry has actually matured quite a bit in the last few years, and he's altered his portfolio to match the increased maturity of the fund managers and their experience and what they utilize. And so I think that's actually a positive for us. Anyway, so let's hopefully I didn't lose my space here, but just hopefully, Scott, that gives you encouragement to, just trim what you need to. I know that's tough. When I sold ZWC, I really felt, I want to say it was down almost actually 8%, but it sucks losing that money because it takes so long to save up for it. But it just felt like I didn't feel good holding it anymore. I didn't want it anymore. I didn't want to average down on it anymore. As I was coming to learn more about cover call ETFs, my horizon was expanding to other funds, and I think there are way better funds out there than ZWC. And I'm glad I made that call because, as you can see, the portfolio now, that 8% loss it's a distant memory, and that was only 2 years ago. So anyway. Let's see, Rodrigo at Kelly. Good to know. I have been adding some also, a little curious on the risks though. Let's see, just so I can move down the chat a little bit here. How is it possible to get your worksheet for funds trading in US? Well, by the way, Eugene for Harmony, like the name. Again, thank you for tuning into the chat. And it's just on my Patreon. So it's a Google Sheet. You just click on it, opt into it. And then once you see it, there's going to be a bunch of tabs for Canadian listed funds and American listed funds. And even on the Canadian side, I've made a column for the funds that trade in US currency. And then on the US side of thing, like everything's in US currency. There is no, American stock that trades in Canadian currency, at least none that I'm aware of. And I have like the ticker symbols in there as well. I have everything, the name of the fund, I put a link in it. So you'd click on the name of the fund and it'll take you right to the fund manager's page. So hopefully that helps. Opa says dividends going straight back into more fund purchases. Yeah, I think that's honestly part of the whole wealth building experience. That plays a portion. I think when this is a bit of a side thing here, Opa, but when we talk about building wealth, it's not just about fund performances. It's not about the stock going up. There's so much more to it with wealth building. It involves reinvesting your distributions. It involves your contributions off of your paycheck. Wherever else that you can find maybe some passive income and start building it together. Wealth building really is like the full package. It's not just price acceleration alone. Let's see. Scott, thanks. Appreciate that. Just was concerned about losing TFSA space if it's down. Is that true? Well, that's that. So if it's down, so you would only lose space if you take it out. Okay, so I'll put you this way. Let's just say, I think what was the fund you were talking about? RS. if it had gained, let's just say, for argument's sake, you have 10,000 or you have $100,000 worth of TFSA space. And let's just say RS, by some miracle, even though it goes up to, maybe your portfolio goes up to $150,000, and you decide to extract that all $150,000, even though you only have $100,000 of contribution space, you now just created an extra 50 grand worth of space when the year rolls over, and you can put, and you'll have like a max of 150,000 plus, for next year's maybe $7,000 of space. But it works in reverse as well. If you have $100,000 worth and RS goes down, let's say to 50,000, and you decide to extract all of it, then you'll have only $50,000 worth of contribution space, and plus the $7 grand. So, but I mean, if it stays within the TFSA, then you technically don't lose any any room whatsoever. So the fund can go down 100%, just as long as you're not extracting that amount, I want to say. And so hopefully I'm answering that right. That's to the best of my knowledge. I believe I did that on one occasion. I sold an S&P 500 fund, XSP, and it was like right at the tail end of 2021. And yeah, I sold it, extracted it. I needed to cover some costs, and then I just reinvested. I ended up reinvesting and made a little bit of money on it, so I created a little bit of space. Okay. Reagan, do you have a favorite fund to park excess cash in? Assumptions if you want a rainy day fund or want to stay liquid for a while? No, actually, I mean, I don't have like I call it what do you call it? Yeah, like a cash ETF or anything. It's 100% covered call ETFs. I do keep a little bit of cash on the side for just in a savings account. And I mean, people might say, it's just useless. You know what it is? It's just, what would you call that? It's peace of mind. It's peace of mind insurance. Have a little bit of cash on the side in your savings account. It's probably like not much. So, I mean, typically it's an emergency fund is basically what it is, but it's a really minimal emergency fund. It's probably about 1 month's worth of, mortgage payments and living expenses. It's just simply for peace of mind. I've been tempted to reach into it to, buy the various dips over the past long while, but no, you know what? It's really helped us out for some surprise car fixes, and some other various, just one-time big costs that have come up. And with that experience now in mind, it's been good that way for me. So yeah, 1 month's worth of funds to cover living expenses and the odd repairs. But everything else is just in the all-in-ones, and then my one sector fund. Yeah, so I don't really park cash. Whatever I invest in, I just want to do it for the long haul here. Okay, let's see, Aleem, and on the U.S. side of things. Let's see, Jordan, another Scott question. Jordan, do you recommend for someone who wants to get into cover call investing but has like $1 million to invest, if can only do like 96K in a TFSA, how do you effectively be tax efficient with it? Well, there's actually two ways you can be pretty tax efficient with it. One is you can, if you want maximum tax efficiency, then you're pretty much going for all Canadian funds. You're investing in purely Canadian funds just to pick up, the ETF breakdown, which is broken up into eligible dividends, capital gains, and probably some ROC. So those typically will be the three. A lot of cover call ETFs have a ton of ROC in them. And so that would be the second one, which is looking for funds that maybe typically have more ROC associated with them. HTAE is actually a good example of this. It holds 100% American funds. It holds 100% American equities in it. But the way that the distributions work is it's 100% return of capital. And so that's tax-free right there in a non-registered account. Now, the caveat with that obviously is that who knows if any of these funds will have 100% ROC next year. We don't know. This year's been it's been a pretty uptrending kind of year. So can they bring those tax loss harvesting, bring those losses forward to take advantage of return of capital? That's a little bit harder to predict. But I mean, all you really need to go is go do the T3 tax factor summaries for all of these funds. And you can easily Google that. I mean, to give an example, maybe try Hamilton. Hamilton's pretty easily searched by like on Google search, and you can see all their tax factor summaries over the years with their funds. But you can do this with any fund. It's just some funds are their T3 tax factor summaries are easier to find than others. Like BMO's, like forget it. I had to go through to get that information onto the tracker. I had to develop a separate spreadsheet that could calculate their various how do I explain this? Their various breakdowns. BMO's was a lot more hectic to try to figure out. Got there, it's accurate, but just a little bit more involved. I would say Hamilton's is pretty easy. Global X pretty easy, or formerly Horizons ETFs. I want to say even Harvest as well. But yeah, check that out. Just check out the history. And then what you can do with that, Scott, is, if with a non-registered account, maybe you lean towards ones with more ROC in it. I do have in the tracker, in the tax tab, I do have a section that has a column with ROC. And it's a column that will show you how many years it would take for your ROC to turn into capital gains. And I think that's really helpful because, basically it's based on today's share price. If you were to never touch that fund again, it would give you, 15 years before the ROC, if the fund's performance stayed, let's just say, it stayed the same, it would take, 15, who knows, 20 years for that ROC to transition into capital gains. So I think that's also helpful too. So, I mean, it's either, you maybe have a mix of maybe half Canadian stuff and then maybe a mix of half American stuff with just more friendly with the ROC side of things versus those that, douse out more foreign income or other income. Because, that's you're going to get hit at your marginal tax rate for that. Let's see. TD. I'm familiar with this icon of your, I think. Anyway, TD, Tim from Calgary writes, Jordan, I mostly follow Adriano from PII, as do I, but really like what you're doing with all of your All-Star Tracker. Would you consider expanding it to include split share funds? I mean, I feel like I've been asked this before, but would I? I wouldn't rule it out. The tracker is, in its lifespan, it's an infant still. It's only at the end of this month it'll be 8 months old. So I mean, not that it's absolutely brand new. The tracker has. If you scroll down in my Patreon to the very first tracker, it's like one tab, static data. And then you fast forward to now, it has grown by leaps and bounds. It's become what I've always wanted it to be. But split share funds, not out of the realm of possibility. I think I would probably, in my opinion, Tim, I would probably just need to see a bigger increase in the size of people participating in the Patreon. And then on top of that, probably, other people requesting it. I mean, I'm pretty open when people want, people do influence the tracker and have wanted certain things added to it, other columns. I remember somebody was like, "Can you add links to all the funds?" I was like, "Done, easy. I can do that." So at its current size, you're much easier to influence what's seen on the tracker. If you make a suggestion, I'm much more willing to put it in there. Just at the moment, split share funds, obviously not, not my it's not in my realm of real experience, but yeah, perchance one day I could do, or just develop a separate tracker altogether and stick it in the Patreon, and just for those who I know want to follow split share funds. It can be done. It's just not a priority at the moment. Scott says, "Thanks, Jordan. I heard that if you sold a stock that you were down, say 500 in your original buy-in and sold the stock, you lose that contribution room in your TFSA forever, not just till the new year." Yeah, I mean, I believe that's right. I mean, okay, let's just put it this way. In your example, I think we said RS, right? If you say had $100,000 worth of RS and you lose all of it, you just lose all of it. And then the fund manager is like, you know what, RS is no good anymore. And they just delist it altogether. And you literally have nothing in your account. You don't get that room back just because your investment went down. So you're relegated to, basically the $7,000 a year of contribution of future contribution space. So it would work the same way. Okay, so I see, because I was making the difference of, whether you extract it or not. Yeah, but in that example, you have nothing to withdraw anyway. So yeah, you would just be relegated to whatever future contributions you're allowed to make. Yeah, I know it's kind of an oddball one there with that, but yeah, if you're down and you extract that money, it's not like, you don't get that original space back, because it's based off of what you withdraw. So like whatever you withdraw, you get that back. So you see what I'm saying? Like if you're down 50%, you extract that. Well, yeah, you don't get that 50% you've lost in contribution space. So yeah, I mean, I think it's great we have the TFSA, and obviously not so great if you're down on something. Could certainly feel very, like, gee, how do I wait? Do I pull the pin and sell it? But hopefully that answers your question. All right. Let's see. Shane, thanks for joining the chat, Shane, if you're still here. Hey, man, late joining. And if this was already asked, just ignore and I'll check out later. What did you ask? Okay. Let's see. Aleem. Let's see. The EQT ETFs, XEQT, FEQT, ZEQT, HEQT seem to have much higher AUMs than even the HYLDs, for example, and are quite popular, although XEQT 500 million versus 4 billion. Yeah, I don't argue with that. What's that put out by? Is that iShares, BlackRock? Like, I mean, it's one of these ginormous fund managers. So I think they've also been around a lot longer, and that's just part of it too. I think in the last couple of years, this is where you've really seen the more mainstreamness of cover call ETFs, and yeah, the people, or I should say the fund managers that put out the cover call ETFs, I think they more or less just specialize with income-based products, and not necessarily a giant fund manager that's kind of dipping their toes into everything, and that's okay. They're growing. There's a lot of good things with the fund managers that we have. I think many of I got to meet Michael Kovacs of Harvest ETFs recently, and Harvest just subscribed to the channel, which is obviously exciting on that front. But I know that they don't have, $1 trillion in AUM across all their funds, but I think it's just maturing as always. I think in 10, 15 years from now, right? I mean, who knows how big some of these fund managers will get, but it's just time in the game. That's all it really is. And for these fund managers, it's no different. Let's see here. Although I don't like the quarterly distributions with XEQT versus monthly, like HYLD, I'm curious to get your thoughts on comparing total returns of XEQT versus HYLD, for example. Yeah, I would have to do maybe a video or something. I don't have the total return info just offhand here for XEQT versus HWL. I mean, these are two funds that are built extremely differently. Even cover calls aside, XEQT is just an all asset, all allocations, all geography kind of fund, right? It's the everything fund, and that's what makes it popular. It's your one-stop shop. It's put out by a huge fund manager, in my opinion. That, right? I mean, BlackRock's not going anywhere. Whether despite your opinions of BlackRock or Vanguard, they manage trillions of dollars. They're not going anywhere. And if something happens to them, every other fund manager below them is also in trouble. So yeah, maybe a future video, Aleem, when it comes to that. But I would say, you know what, HYLD, it's S&P 500 centric. And I think if you believe stocks are going to go up in the long haul, I think HYLD, like I said, I think that's the one you probably want to target if you want price appreciation out of your all-in-one ETFs. I think it probably has the best chance at price appreciation while collecting, what is it, a 13% yield, or maybe just under 13% at the moment. Shane writes, so what are your thoughts on only going to cover call ETFs that will naturally have capital growth potential, thinking how target yield will grow relative with the NAV appreciation? Yeah, I kind of touched on this sort of earlier in the chat, but for those just opting in now, I'll touch on it lightly. I mean, that is my whole mantra. That's what I try to achieve, and by showing you all with the community posts every Saturday. I think I'm on post number 37 now, so you can literally just scroll through that community feed, and you'll see how the portfolio has grown over time. I think it's a great quick way of just if you have questions, or maybe you have issues, or maybe you're not really sure of yourself if this is the pathway you want to take. But if you're hearing it from me, I'm trying to maintain price appreciation. I want my portfolio to grow on a price only basis while I collect the 10 to 12% yield at the same time. And I'm 100% cover call based. So I invest mostly in the all-in-ones, with one sector fund being HTAE. But so far this year, it's been beating every index. And to my surprise, I think over the long run, that's not going to be the case. Cover calls are not built to do that. They are cash now style ETFs, meaning they're meant to just be extracted now. Yes, I reinvest. That's just how I choose to build wealth through them, because I want the flexibility to extract them in time. And yeah, if I lose out on whatever total return in the next 30, 40 years, trust me, I'm totally okay with that. I value my flexibility over 30, 40 years down the road. Yeah. So hopefully that answers your question. But yeah, give the community tab just a look, and I have how the portfolio has grown, and how my portfolio has grown on a total return basis versus the four other major indexes that we have, right? So the TSX 60, the Dow Jones, the NASDAQ 100, and the S&P 500. Okay, let's move along. Oh yeah. I mean, if Aleem has done this with me, so if you want to book a one-on-one, I will address this. Not that anyone has said it, but for content creators, this is actually by far and away any channel I follow that I respect, that teaches about building a sustainable channel, a channel that is, built for character, right? I don't want to do it just to be clickbaity and whatnot. I mean, they all pretty much say the same thing. It's like connecting with your audience, coaching. That's by hands down the best way to connect with the audience and get like a hands-on understanding with what other people are dealing with. And also when you're, building a business, that's obviously a good way to generate revenue on as well. And at the end of the day, my favorite part about this channel is just speaking with you guys and just doing what we're doing here. It's great. It's like I'm having fun with it. I get to freewheel and just answer all your questions. Matthew writes, I'm getting farther, getting away from the chat here. XEQT has been around a lot longer. It's also pushed on the Canadian investing Reddit. Yeah, there's definitely a lot of that. So I definitely agree with that, Matthew. And you know what? Again, if you want to be, let's say maybe you want to be, for lack of a better word, it's more of a layman's term, you want to be a couch potato investor. You want your money to participate in markets, but you don't want to know nothing about investing. You don't care. But your buddy's like, look, you can, I think you'll have better returns, pay less fees. Then, an XEQT is like a good way to go. It covers everything. And, it's certainly for someone who I think, life is busy, but you want to participate in the market. I think that's just the best way of putting it like that for XEQT. But you could do the same thing with the NASDAQ or the S&P 500. These are funds that allow you to invest and go about your day. Lily Zhang. Hi, Lily. I know you're been a regular contributor, so thanks for stopping into the chat. Do you understand split stocks better now? The price action does not reflect the underlying quite often from other observations. Adriano's your best bet for split share funds. I am woefully inexperienced with split share funds. I pretty much dedicate all my energy, or at least most of my investing energy, into keeping up with cover call ETFs and just really trying to master that. Split share funds, I'm honestly, I don't really know how they work. And I know some of them, I believe, use cover call ETFs. I might be botching that, but anyway, that just goes to show that it's not my strength. Matthew, most of these cover calls are relatively new. Yeah, that is true. A lot of them are pretty new. There's been an explosion of them in the last few years. Probably the oldest one probably dates back to maybe 2010. But I would say that the most efficient ones have come out in the last couple of years. The ones that I think have really moved that ball downfield with innovation. At the end of the day, an ETF is just investing in underlying assets that have maybe been around for half a century. It's just what it's composed of. I mean, the S&P 500 has been around for a long time. So stick and cover calls just in general have been around for a long time. So stick them together and put them in an ETF, and all of a sudden it might give the veil of risky or not. It could be, I would just say might give the veil of being risky, but yet these two things in isolation are pretty conservative ways of investing, especially just writing your own cover calls. They're pretty plain vanilla strategies, but you put them together and I think you get a unique product. But I get what you're saying. The fund overall, a lot of these funds are newer, but I think that's maybe hopefully a more helpful way of looking at that. They all need time to mature for sure. And I think there will be many that, will stay at the top of the heap. And I think the all-in-ones are a good indicator as to the ones that are going to probably stick around for the long haul. But like I said, the ones that I feel like are not going to stick around, I'll do my best to warn the community about that, or at least give you a heads up. I do try to stay away from panic sell, you should definitely buy this kind of stuff. But also, right, I also want to be able to just give some lessons as to what you just need to look out for yourself. If you're going to invest in a certain fund, maybe you have the tracker and you're just curious about if I should invest in these funds. Well, staying on top of volume and AUM is a really good way, and seeing that month over month is a really good way of really determining whether you invest in a certain fund. Do you really want to invest in a fund that's $4 million? Its AUM has been declining for a year and its volume has been decreasing. I mean, these aren't necessarily the first questions a lot of investors ask when they're choosing ETFs. But I think it's if you're going to be investing in this for the long haul, I think you should. Let's see. TD TFSA is whatever you withdraw can replace. Losses cannot be replaced with headroom. Yeah. So yeah, I agree with that. Tim, Scott, thanks. I know. Okay. Yeah. Let's see. Retired thoughts. Markets going up and down. Right now it looks scary. I am new to this. Looking at 4 ETFs, HDIV, Bank, ENCL, and UMAX. I just wish Wealthsimple would do the dips. Yeah, I mean, if you're a newer investor, I understand. Literally 4 years ago to the month, someone I respect very highly at work, who's been doing the investing game for a long time, who owns real estate all over the place, and he's just a regular pipe fitter like me, but has done really well in the stock market. He one day he was like, Jordan, do you know what a dividend is? I'm like, I don't. I've heard this term, but it's like asking what is cheese. It's like, I know what it looks like, I know what it tastes like, but like, describe it. Like, what is a dividend? I don't know. It's some form of money, right? So, and that's what really stirred the investing kind of got the wheels turning about investing. I was 30 years old at the time. I hadn't invested for myself. Wasn't interested in investing until then. And I think one of the early things, this like mentor from my work helped me with was really on a regular basis, just telling me like, look, man, the market's going to go up, it's going to go down. And it's been like this throughout all of history. And he would show me charts of like dips, and it's just chock. Every dip throughout history is just chock full of events. And it's like, I mean, are you going to stop investing because of this little dip? Like, I mean, right now, if you were to look at, say, the past month, what you're going to see is what looks like this giant peak, and then just right. It's like jumping off a diving board. And, but when you zoom out and you look at the big picture over 1 year, 5 years, when you look over all time, it's it's just this little blip. It's just context. There's always going to be trouble. And I would just encourage you to stay invested, and it's just time in the market that'll help you get over the hump of being nervous. I'll give you a good example of just how nervous I was. I was buying my first ETF. It was $300 worth, and I kid you not, my finger was shaking as I was pushing the button to make the buy on Questrade. I was so nervous. I was like sweating. I was in my car. And now I'm 25,000 grand or 25 grand this way, like 5 grand this way. And it's like, it's just time. And time will make you a master of this stuff. As long as you put in the effort, right? Like, if you're the couch potato investor, you might stay scared, but if you're willing to put in the work, and honestly, as long as you are, keeping with the language of finance, or just keeping up with the language of finance, then you'll be okay. So just more time, just listen to a podcast in the car, or even a video. Sometimes I'll listen to Adriano's videos on my way to work. I'm not watching them, but like, I'm just listening just to keep up. And I'll do that with other channels and podcasts and whatever. I got a long drive to work. I'm like in my car for 2.5 hours a day. So I got a lot of spare time to just listen to stuff and various things. Yeah. So, okay. And then the other half of your question. Yeah. So you're picking a pretty tax efficient portfolio: bank, ENCL, UMAX. In my opinion, these are probably the three funds I'd invest in the Canadian market. Yes, there are more industries or other sectors you could get associated with, but these are like the big power players in Canada: the utilities, energy, and financials. They eat up a massive chunk of that sector pie. So I'd be okay with those three funds, and even HDIV as well. It's 75% Canadian, it's 25% American, as far as geographical makeup. But I'd go with those. If that's all you go with, I would just obviously explore the other all-in-ones as well. I think it would be helpful as well. Maybe potentially, maybe think about maybe doing like a half and half style. So maybe half the portfolios, maybe all-in-ones with, if you're familiar with, well, if you're newer, the tax breakdown is just what we were talking about earlier. It's just has more ROC associated with it, return of capital, and that would make a non-registered account more tax efficient. Drips. Okay. Let's see. Let's go. KD writes, I started to track my dividend payments once my dividends earned are greater than the loss of capital. Consider selling. I am down $800 on RS, but I have gained more in dividends, roughly $1,100. Yeah, I do as well. Well, I don't own RS, but if you are someone who's with Wealthica, it gives you you would see this in my portfolio overview videos, and I usually go by total return column. And I think the last one I did, I still had ENCL, I still had UMAX, I still had BKCL, I still had HMAX, and they were down price-wise, but over the long haul that I've had them for, their total return was in the positive, and they were all, up, I don't know, 5%, 7%, something in that range. So they were all up. All right. Good night, Opa, who lives on the other side of the continent. All right. Let's see. TD. Let's see. Increase its interest rates and go down. That would be a good buy. Aleem says, I would certainly recommend session with Jordan. Always a good balance approach and get some feedback. Well, thank you, Aleem, for recommending that. Yeah, it's. I think if you want something that's really tailored to maybe something you want, I think that's a good opportunity. I did a ton of free one-on-ones between October of last year and March of this year, really just to put my feet to the fire and really get tested. And I assure you, people certainly all over the country definitely did test me, especially when I was a lot, almost a year ago in October when I first started. I was offering it, for free. I had one Patreon member reach out to me, and they're like, I saw you were doing free one-on-ones. I should have taken advantage. I thought it was a scam. I'm like, no, it actually wasn't. It was like literally a free Zoom session, just so that you would do, like, if you opted into it, you would do it because maybe you get a little extra context. I benefited from it because I knew I'd eventually want to charge something for that. So it was just getting more experience and getting experience with people's different pains and problems. So I knew I had to do that for a good chunk of time. And I was probably doing about 4 one-on-ones every weekend. I mean, when it's free, people really take advantage of that. So no surprise there, right? But you pay a little bit of money, and I mean, it's immeasurable how it could potentially help you. Maybe it doesn't help, but I think the benefits of, especially if you come with questions and kind of what to ask, that definitely helps. But I also include, if you don't know what to ask, I do include in the sidebar with it just options that you can go with. Like if you want a tour through the tracker, I can do that for 60 minutes. If you want a tour through a fund manager website and like knowing how to break it down and what to look for, I do that as well. So if you want like a tour, it can be that as well. It really can be whatever you want it to be, but I do give you guys some ideas for topic of discussion. Let's see. Question order. Aleem, thanks. TD will take a further look at EQCL, and Jordan seemed quite positive as well. I had initially just avoided EQCL because of the low volumes and low AUM. Now I get it. It's the volume. I mean, the AUM volume has really started to kick up ever since they added those they've made it fully cover call ETF based. We're just waiting on the distribution increase. There's about 40% there that we want to see, added to that distribution. I think it's at 21 cents. I mean, I think with 40%, it should jack it up to, I don't know. I mean, I think a conservative estimate somewhere in the 13.5% range. But yeah, it would be good to see that. Let's see. Kelly writes, Sal Matpo, thank you, sir, and great job on your first live stream. Time for my morning walk in the tropics, thanks to retiring early on dividends. Yes, absolutely, Kelly. Thank you for being a supporter of the channel, and enjoy your walk on the beach and retired life. Financial independence. I mean, people who follow this channel, the people I've been able to talk to, it's pretty wild getting to meet people that have multi-million-dollar portfolios, and just looking to how to manage their own finances just a little bit better. And trust me, I don't want to do it for you. I would rather you just learn and just do it yourself, because I have seen exponential growth in my own portfolio from a knock-on effect from the education and just being involved and just taking the time to really actually plot out where I want to go with these, and that's really helped. Having a destination for your investments is bar none. You need it if you want that kind of return. I think a stat that I once cited, which is honestly, it was one of these sort of eureka moments. And it was on the Rational Reminder with Ben Felix, who I listen to all kinds of stuff. So Ben, really respect. Yeah, he's a little, he's like the finance science guy, right? Everything is very much by the proof, or what's the word I'm looking for? I don't know. Proof that it can hold up in the long haul. But he had on a German economist a couple of years ago in October 2022, and this German economist was talking about how they did a long form study. People were 30% better off in retirement if they knew how an interest rate worked, if they knew how a credit score worked. And there was one more thing in there, but it was just the education. And they were 30% better off if they understood those three things. Well, imagine what your returns are going to be like over time if you understand how an ETF works, how you understand how different accounts work, the difference between Questrade and Wealthsimple, the difference between a TFSA and an RSP. If you kind of maybe dabble a little bit in taxes. I mean, all this stuff just has a knock-on effect. And I'm speaking from what I've seen from my own portfolio. It really started to ratchet up as my education kind of moved along, and I tried to, make more well-informed decisions. But if it's just, pick a name out of a hat at random, right? I think you can do better. You'll get some kind of return for sure, but the education matters, and I think what's that saying? The score will take care of itself, right? In basketball, right? If you practice, the score will take care of itself. And in this case, it's no different. Let's see. Oh, I'll botch this. I'm sorry. Jadu. Hi, what happens to NAV when markets take a nosedive like recently? For example, what happened to HDUV, and how will it affect the yield? Are you talking about HDIF? I'm not familiar with an HDUV. That's not a cover call fund. I don't believe so. Jesse, you just maybe in the chat, just maybe just clarify which kind of fund that is. But I will try to answer the question. So yeah, what happens if NAV when markets take a nosedive like recently? Well, naturally, okay, okay, all right, that makes more sense. Yeah, I should have guessed that HDIV. Yeah, so I mean, so this is where sort of my philosophy around cover call ETFs come into play. I think if we can develop a portfolio of, say, all-in-ones that has price appreciation over time, that means that if the floor totally drops out like a trap door in a cartoon, right? That with time it'll be able to claw back and get back to its original place. Maybe it'll be a bit slower, but I think on a psychological level, I think that's much easier for us to absorb versus maybe funds that do not have, like, they pay absolutely everything out in their distributions. That is, I think, going to be tougher in the long run for investors who have kind of gone more that route. So, right, that's why I invest for both price appreciation and yield as well. So 10 to 12%. That's the range I have found that has been so far has been a good sweet spot. And yeah, I wouldn't don't hold your nose up at 10%. It's a great number. It's a terrific number. But as far as HDIV is concerned, I can't remember its all-time return, or say its year-to-date return already. Again, with it being more Canadian-based versus the S&P 500 or the American market, it's going to grow slower. Canada is not built. Our index, our main index, like our S&P 500, the TSX 60, is really not built to beat the S&P 500 over the long run. We'll do well in specific events like 2022 when oil shot up and the TSX 60 did really well in that period. So I think it's having things that are maybe, say, HDIV is probably a nice complement to maybe other funds that are more growth oriented if you put cover calls on them, just because it offers a bit of a yin and a yang. If tech takes a plunge, maybe HDIV, it does help stabilize the fund. I have noticed that with that fund. Can it recover? Absolutely. It's funds. I believe. I think because they're yield maximizers, they write calls on up to 50% of the portfolio, whereas some of their other funds like SMAX, QMAX are 30%. So does it have a chance? It does have an American component to it. So probably a little bit slower. But I honestly, in my opinion, HDIV is probably just going to be a steady Eddie. So it probably won't grow a lot, but I think it'll just stay just enough ahead. But it's not going to do gangbusters on its price performance. Okay. Let's see. Katie, when you open a non-registered account, would you consider making the TFSA entirely? Sorry, missed that. When you open a non-registered account, would you consider making the TFSA entirely growth cover call ETFs like HTAE, just to build even more contribution room over time? There's probably not one idea. I've certainly considered that. Absolutely. I think I've considered like every conceivable scenario, but I think at the end of the day, I'd kind of just come back to super boring. Essentially, it really is a beginner's portfolio. If you're looking to get started in cover call ETFs, like my portfolio, maybe minus HTAE, you just want something simple to start off with. Investing in HDIV, HDIF, HYLD, HDIV, and EQCL, like they pretty much cover everything. And there's even a chance that I have that exact same portfolio in a non-registered account. At the moment, though, I have said that I want to do UMAX, ENCL, and bank in my non-registered. I've even considered having those three with some maybe more growth-oriented cover call ETFs, so more like QQCL. Maybe I'd add in maybe a QMAX in there. So not necessarily an all-in-one, but just an index-based cover call ETF into that mix, just to help it grow. Because if I just have those three funds, very tax efficient, higher yield, but the natural price growth is certainly going to stall out. And I would need a little bit more in that portfolio to kind of help it out. So I'd probably tweak it that way. Okay, I'll do maybe a couple more questions if you guys got any here. We're rolling on an hour and a half. Trust me, I'm not even tired. I could probably do another hour and a half of this. But yeah, just for the sake of time, and I got to get back to the family. Let's see here. Jazoo says, or an ETF. So back to his question, what happens if the NAV goes down with, say, an ETF? Can you give an example? How does falling markets affect leverage cover call ETFs like HYLD, etc.? If they write at the money calls, then what if it gets called? What happens then? So if I just understand it correctly, I don't want to mess up the answer here. How does falling markets affect leverage cover call ETFs? Yeah, they fall harder. Certainly, leverage. Keep in mind when you put cover calls, if you put a percentage of cover calls on any kind of fund, that portion of the portfolio, it's going to drag on the price. So obviously the price is going to get slowed down compared to maybe a non-cover call version of that fund. So the leverage actually helps to negate that. So it can actually compete with the non-leverage version of that fund. So in this example, maybe I'd say, let's just do HYLD versus VSP. So that combination of the leverage will help to keep pace on a total return basis with VSP. And if they write at the money calls and it gets called away, what happens then if it gets called away? Yeah, well then, so if it gets called away, and that's also dependent on the person on the other side of that, right? They have the right, not the obligation, to exercise that call. And depending on where price is, they might not even necessarily exercise the call option. Just saying. But yeah, if it gets called away, yeah, what happens in that scenario? Unfortunately, I don't have a great answer for you on that regard. It gets called away, yeah, because I understand like where the confusion might be. It's like you would think that, okay, well, it's making its money on its premium, right? And then it pays out a certain amount to all of us. So, and then it just maintains its AUM. I mean, this is obviously a very common. It's a common thing, a common exercise for all of these fund managers. But maybe, I don't know, maybe someone else in the chat will have a better answer than that. Yeah, and then TD says, going back to a question of would you have growth in just the TFSA? TD writes, yeah, TFSA is growth only. Yeah, I get it. Right, it's tax-free and it's pure rocket fuel in that regard. Yeah, you could certainly do that, but for the long haul, I just want something boring, and I could do that, but yeah, I just want to own everything, absolutely everything. No stone unturned. I want every part of the economy. But you know what? Especially if you go for the tech sector, I mean, I think that's where future productivity is going to be found. I don't know how much you're going to find it in really energy or some of these old, kind of more traditional industries. Yeah. And then TD writes RSPs, global growth bonds, not tax or untax friendly income. Yeah. Yeah, I'm probably gonna just wrap it up there, right? Let's read the last couple of comments. Thanks again, Jordan. Have a good evening and see you the next time. Look forward to when I pull the trigger on a one-on-one. Got to go with the fam. Yeah, same here. So yes, take it easy, Scott. Enjoy the rest of your summer. This is getting called away baffles me. How do they manage it? The fund manager has to buy it back at a higher price. Yeah, okay, okay. Lily, great answer. Yeah, they just buy it back at a higher price. I mean, actually, now that I think about it, I'm like, yeah, obviously they have to buy it back. Anyway, at the money options, being in the money can be called anytime. So don't get this part. Okay, I'd like to have a one-on-one with you. Yeah, no problem. Just you just go to, I think it's one of my, pretty much any of my newer videos you'd see in the link in the description. Like in the description or in the very first comment, you'll see a pinned comment, and it'll see like tracker, a link to the tracker, and then a link to a one-on-one. So you just click on the link and then you can book there. It's so that's probably the best way. I do have links on my homepage to YouTube, but I think I only have the Patreon link there. So anyway, that's one way you can go there. KD, I was allured by that guy that grew his TFSA to 800K by investing in Shopify. I was thinking to make my TFSA HTAE and other semiconductor ETFs while maintaining HYLD among others in a non-registered account. Yeah. Well, I'll tell you what, guys. I'll let you in on a little behind the scenes here, because I know where KD's going with this. I know the person you're talking about, Marcus. I'm part of Adriano's his what do you call it? His Inner Circle Plus. And I was sitting in my car before work one day, and this article pops up on my phone, and it was the Marcus article. So then I shared it with the Inner Circle Plus community, and I just basically told the community, I'm like, oh, look, the guy has learned what he knows from YouTube, so he's gotten YouTube exposure. And then I just said, hey, Adriano, I mean, it's probably you, in the big grand scheme of things. I'm newer, and I'm still a minnow in a big sea of sharks and whales and other big YouTubers out there. And then I mean, Adriano pursued it, and really glad he did, because we got to know a little bit more about this Marcus fellow. I think that's his alias. And I think he admitted, he got lucky with Shopify, and then transitioned into cover call ETFs by watching Adriano's stuff, which is great. I think Adriano's been, a forerunner in this space for all of us. I've told him that personally. I consider him a mentor, and I've told him that, and he remains that. And I still watch all of his videos. Even if it's a topic, I'm like, oh, well, I know that topic. It doesn't matter. I just watch faithfully, just because I like the content he's done. And he's also been a big supporter of this channel as well. I remember when I was at maybe 500 subscribers, he put out to his whole community. He's like, hey, man, he's like, hey, everybody, why don't you sub this guy's channel, cover call ETF investing? And then, oh my goodness, I saw my subscriber count go from 500 to 1,000 in 2 days. And I was just blown away by that. He didn't have to do that, but I really respect the guy for that. I mean, I think, Adriano has 5% of his personality is very fiery, and I think when he does show that, it is actually kind of refreshing to see, if someone says something kind of lame about the strategy or attacks him, it is kind of nice to see that that fire in the belly, and not just be absolutely totally passive. But he definitely does a professional job with his channel, and I think I think, with a bigger channel, you just get the criticism. I think that's par for the course. You're in the court of a public opinion, and there's just no way of totally getting around that. But yeah, I absolutely respect the guy for that. But yeah, it was just like I said, it was just a kind of going off track there. But with Marcus, yeah, it was cool to just see Adrian like run with that topic and get in contact with that Marcus fellow. Jazud, you wrote, what's your website? Can I paste it in here? Yeah, I mean, it's not a website. I just have a Patreon account where people can support, my work through, I mean, the big thing is the cover call ETF All-Star Tracker. If you're a Patreon member, I also do, I do Zoom sessions with up to 10 people. And we just hang out, have and just it's just I get to know you guys a little bit more. I like to keep it small group in orientation that way. So even if like the Patreon grows, I would probably just opt for more 10-person Zoom sessions with them. So whether it's workshops, Q&As, hangouts, whether you just want to ask anything, I think that's I think a nice compromise. If you don't want to pay for the all-in-one, or sorry, if you don't want to pay for the one-on-one, you can join there and just be a part of the group chat. So it's at a slightly, it's at a reduced price, obviously, right? You got one-on-one is $100, and to opt into the Patreon is $13 a month. So it definitely gives you at least some options there if you need a little bit more hands-on, but it's in a group setting. TD, thank you. Really appreciate that. It's just the fact that you all are here is great. And it's I had this, I know it's stupid to say, but I had this, like, being that it's my first live stream, I was like, oh man, what if 0 people show up to this thing? I mean, how embarrassing. I was like, well, maybe I'll just like freewheel just a few topics and go from there if nobody showed up. But hey, you guys actually, I think a really decent attendance for this and participation as well. We're already way past like 7:30, and I'm just because I enjoy this. I enjoy talking with you all. But man, I really need to wrap this up. Yeah, thanks and good night. Let's see. Happy payday tomorrow to all Brompton and Middlefield Fund holders. Cheers and good night to all. Yeah, Brompton. Yeah, absolutely. Brompton is what's going to put me over the top for most, most distributions in 1 month, not from a single payer, but like as a total. So along with my portfolio performance post I put every week, every month, I put out an income performance post. So you can actually see how the income distribution has grown over time. And I just reinvest everything. If you're curious about what I contribute, it's a solid $1,000 a month, no less, no more. I always there was a period I tried to do more, but once I really locked in one number, I was just happy with that. I was probably happier than if I put in $1,500. I don't know. It's weird. It's just it's all psychology. It just meant that, if I did make extra money somewhere else, I could put it towards, family stuff, or, put it towards the side for a trip or just something else. So if I found that once I committed to a certain amount, I found that I was much more willing to stick with it, and I was happier for it. Yeah. So through that video, I do have one-on-one availabilities for this actually upcoming Saturday. I got 2 slots available. I'm not going to do many slots, just with family life and work. I typically work up to 50 hours a week, tack on a 2.5-hour round trip, drive to and from work with 3 kids and married and whatnot. So when I do all-in-ones, it's probably for now on a monthly basis. I'm probably going to do like a max of 4. I'll put out availability for about 4 spots. So right now, I think all 4 are still available. So you can either choose this Saturday or next Saturday, and there's 2 slots. It's I want to say 9 a.m. Pacific Standard. No, Yes, 9 a.m. Pacific Standard Time. I think 10:15, somewhere in there. It's like in the morning Pacific Standard Time. So you just book it there. It's just, again, go to like my videos and just pick one, like the very last video I made, and there will be a link in the description or in the comment section. You'll see it. It'll be blue. You can't miss it. So that's the best way to find the link for that. Yeah, so yeah, just book it there. There's 2 slots this weekend, next weekend, and you'll be fine. And then you can even write a note. Yeah, so like if it's 9 a.m. here, it'll be 12 there, whatever the case is. So it'll be afternoon either way for you. Yeah. So yeah, and that's just like I said, there's, when you kind of go through the options of what you want to talk about, we can talk about whatever, but I also do list. I give you all options for, if you have no idea what to talk about, I give you options of what we could talk about if some of that will interest you. It's just credit cards through Stripe. They're really well known, really known for like credit card transactions. So yeah, it takes I wanted, and it's using Stripe. It, like, if you go through the steps, like you click on the link and you go through, you pick your time, it'll take you step by step. It's professional. It's through a scheduler, a website called Calendly, and yeah, it's a very a lot of people use the site for scheduling meetings and especially coaching sessions as well. So it gives you the option for Stripe. And Aleem here in the chat, he's done it before, and there were no issues with that. So just try it out. And if you have issues for whatever reason, just email me at covercalletfinvesting@gmail.com. Yeah, I mean, right. It's I hear you on the e-transfer stuff. I really want to try to keep this the way it's set up. So, if you want to go into, if you want to, or if there's something with issues with credit card or whatever, maybe just email me, and maybe we can work something out that way. Ideally, I'd like to stick with the scheduler because it's right. It makes it automatic. So I like it from that standpoint. So ideally that way, but if there's other issues, just contact me, and maybe we'll figure something out. No guarantees, but we can do that. Yeah. Okay. I'm notorious for this, even in the one-on-ones. I go overtime. So yeah, just hopefully you all enjoyed the chat, and I'm signing off now. So yeah, we'll see you in the next video coming out Sunday. See you later.